Investors are still very concerned about Europe and whether or not any of the debt problems in the continent will spill over to the United States. So what should people be doing right now? How concerned do they need to be? I'm here with Mohammed El-Erian, the CEO of PIMCO, to talk about the Europe debt crisis and what it does mean. Thank you very much for being here, Dr. El-Erian. I appreciate it.
Thank you for having me.
I guess the first question I'd have, the one that's on investors' minds, most prominently right now, is the reaction to the Europe debt crisis overblown, or have investors not really, maybe frighteningly, factored in to how much worse it could get right now?
I think the average investor is starting to understand how complex the situation is in Europe, but isn't there yet. So I suspect that you're going to see more concerns, and it's warranted concerns. There are four distinct factors in play, all of which are reinforcing each other. First, we have an issue of over-indebtedness in Europe. Certain countries are over-indebted, and so far the approach has been to treat their problems as a liquidity issue, not a solvency issue. The second element that's becoming clearer day by day is that Europe may not grow as much, that Europe needs austerity, and therefore growth is not going to be the tide that will raise all ships. The third element is that the institutional setup in Europe didn't allow for what's happening today. And fourthly, a lot of investors are still offside. A lot of investors have invested on Europe based on a notion that what's happening today could not exist. You put all these four things together, and we're still early in the recognition of how important this European issue is for global investors.
Right. With all that in mind, I think a lot of people are now predicting that the euro will fall even further, that possible parity with the dollar sometime in 2011 is possible. Do you agree with that assessment? And to take it a step further, is the demise of the euro something that people now need to be worried about, whether or not certain Eurozone nations have to leave the euro, and maybe we don't go back to the days of the drachma and the peseta, but we may have individual currencies as opposed to a multi-nation currency again?
Yeah, I don't see a world in which all the 16 Eurozone countries, so all the 16 countries that now have the euro, go back to their own individual currencies. So I think the euro persists, but the question mark is whether the group of Eurozone country remains at 16. I suspect the most likely scenario for the next 2 years is that number shrinks, that certain countries take a sabbatical from the euro, not from the European Union, but take a sabbatical from the Eurozone, get conditions in place that allows them to address both their solvency and their growth issue, and then look to come back. But as a core, I think the euro stays. I think you have a set of countries led by Germany who will see merit in being part of a Eurozone, but it's likely to be a smaller Eurozone than what it is today.
Right. Are the countries that might take, as you point out, a sabbatical from the euro, the obvious five, the pigs nations that everyone keeps talking about, Portugal, Ireland, Italy, Spain, Greece, or is there potentially even more Eurozone nations that could be at risk of having these debt problems affect them as well, might need that sabbatical from the euro currency?
If Europe recognizes the issue quickly and gets out of the denial mode, which is there's nothing wrong and this is all about speculators, but if Europe recognizes that the Eurozone right now consists of apples and oranges, if they recognize it early enough, it need not even be the five. It could be a smaller number of countries that take a sabbatical. And ultimately, it's simple. You just look at the stock of debt, the profile of maturities, and the ability to grow yourself out of your debt. And for certain countries, it is very difficult to see that happening with the current structure. If they persist in the current structure, then we're going to replay the 1980s when the whole of Latin America had the lost decade.
Right.
So that's the alternative. It's the lost decade.
Great. Well, obviously not great, but it's definitely a point that I think a lot of people are not really considering right now, and especially when it comes to the U.S. I think you raise a very interesting and eerie comparisons to 2008 in terms of people starting to blame speculators and short sellers as if they're creating the problems as opposed to trying to capitalize on some of the problems that exist in the global financial system right now. So with that in mind, has the U.S. already been proactive enough to take steps to avoid maybe a similar fate to Europe down the road, or are there really tough decisions that still need to be made? Are we still in denial mode in that respect?
we in the U.S. still have tough decisions to make. Now, we have more time, right? And we have more time because, first, we're an economy that provides public good. So, in fact, we benefit when the rest of the world is having issues. And you see that in terms of the strength of the dollar recently. You see that in terms of flows, capital that's coming out of Europe into the U.S. So we benefit from being still the largest economy that provides the reserve currency. So we have more time, but we have the same issues long term. Over the next 3 to 5 years, we have a fiscal problem. Over the next 3 to 5 years, we have a growth problem. And the longer it takes us to address that, the more problematic the next 3 to 5 years are going to be.
So do you think that the problems in Europe have the potential to cause another recession, a double-dip recession for the U.S., or maybe that's not the right question? Is it maybe the case that the recovery that a lot of people, particularly investors in the stock market, have been pointing to from the summer of 2009, maybe we weren't really in a recovery, and this may be just the extension of the downturn that began in late 2007?
You know, we've had a wonderful cyclical bounce. It was motivated by an enormous amount of stimulus on the fiscal side, on the monetary side. A lot of money was pumped into the economy, and you got this wonderful cyclical bounce. And people, unfortunately, extrapolated to say everything is fine. The reality is that this cyclical bounce is hitting a structural wall. It's hitting structural problems that will take some time to resolve. In Europe, that process has been accelerated. In the U.S., you're seeing it slowly. Our whole idea, our whole image is that we are now on this bumpy journey to a new normal. And a new normal, unfortunately, implies lower growth for industrial countries. It doesn't imply depression. It implies lower growth. It's a world of re-regulation, and it's a world of deleveraging. And that is what Europe is going through today. That is what the United States are going to go through. So rather than look at a depression, what we're going to see is the reality of the structural issues is going to dominate this fantasy that we have with the cyclical bounce.
Right. The notion of the V-shaped recovery, one of the kind of jargony terms that a lot of people have been throwing out as the possibility for the U.S. economy after we hit bottom in 2009. It seems like that really is probably not a reality, that we're going to have that sharp spike. So with that in mind, what should investors do to position themselves for this new normal?
First, retain optionality. This is not the time to get stuck in illiquid trades and high-risk trade. The return of your money is as important as the return on your money. So first, retain optionality. In that context, being in the short term in treasury bills where you get both liquidity and safety allows you to have optionality later on. We know one thing for sure is that when sell-off occurs, they are very indiscriminate. They tend to bring down the good as well as the bad. And that is when you want to have liquidity. That is when you want to have dry powder to be able to take on names that make total sense in risk space that are trading at low prices. So the first thing for the investor today is to make sure that they have that optionality going forward. One of the concerns we have when we look at the market as a whole is that the market over-romanced the cyclical bounce. So we still have a lot of people that have too risky a portfolio, and we expect that that's going to contribute to the down trade before there's opportunity to pick up cheap paper here.
Right. China obviously may be the biggest wild card of all, and you mentioned that clearly there's becoming a realization now that European economic growth is going to be stagnant probably at best, and it's going to be bumpy in the U.S. as well. China's taking steps to slow down their economy. Does that make China and other emerging markets not a good place to be as from an investment standpoint right now, or do you think that because of the fundamentals are still probably superior to the U.S. and other developed markets, that may be where investors should be increasingly positioning themselves as part of a diversified portfolio, of course?
I think long term, you want more of your portfolio to be in emerging markets, in emerging market bonds, in emerging market currencies, and in emerging market equities, long term. Why? Because we live in a multi-speed world where the industrial countries are going to be the slow growth areas, and the emerging economies, the ones that have got their act together, the ones that have strong balance sheets, are going to be the fast-growing economies. So long term, you want to make sure that you have the right exposure to the world of tomorrow as opposed to the world of yesterday. Short term, we must always remember that these asset classes are not big enough to accommodate all the capital that comes in and all the capital that goes out. So short term, you may well get an overshoot on the way down, but that will be a good opportunity to increase what is a secular or long-term exposure to areas where growth and where wealth dynamics are migrating day in and day out.